Welcome back, students and scholars. In this class, we are entering ASC 205-20, Discontinued Operations. This is one of those topics where the words sound simple, but the judgment is serious. Many learners hear discontinued and immediately think, okay, something was sold, so it must be discontinued operations. Not so fast. ASC 205-20 is about a major exit getting separate presentation only when the right conditions are met. So today our focus is clean: component, held for sale or disposed, strategic shift, and separate presentation. Let us begin with the biggest misconception. Not every disposal qualifies. Selling old equipment does not qualify. Stopping one minor product usually does not qualify. Even closing a small activity may not qualify. The real question is not, did the company sell something? The real question is, did the company exit a major part of the business in a way that changes the financial statement story? That difference matters. Otherwise, every routine sale would create discontinued operations and financial statements would become a festival of confusion. Today's class has two connected zones. First, we decide whether the disposal qualifies. That is the qualification zone. Second, once it qualifies, we decide how it should be presented. That is the presentation zone. We will move through the purpose, the three gates, two mini cases, balance sheet and income statement presentation, and then common traps. Think of this as a practical checklist class. By the end, you should be able to look at a disposal scenario and say with confidence whether it belongs in discontinued operations or continuing operations. Why does discontinued operations presentation exist in the first place? Because users need a clean view of continuing performance. If a major division was sold and its results are mixed with the ongoing business, users may misunderstand the trend. They may think future performance includes a business the company has already exited. ASC 205-20 creates a separation between what is continuing and what is gone. Continuing operations help users forecast the future. Exited operations are shown separately so the reader can understand the past without distorting the future. Now let us build the three-gate test. Gate 1. Is the disposal a component, group of components, business or non-profit activity? Gate 2. Has it been disposed of or is it classified as held for sale? Gate 3. Does the exit represent a strategic shift with a major effect on operations and financial results? All three gates matter. This is not a buffet where management can choose only the comfortable parts. If one gate fails, discontinued operations presentation fails. The disposal stays in continuing operations. Gate 1 is the unit of account question. Are we dealing with something that can be clearly separated from the rest of the entity? A component has its own operations and cash flows that can be distinguished for management, operating or reporting purposes. It may be one component, a group of components, a full business or a non-profit activity. But it is not just any asset. Selling one machine, one small product or one shared activity usually does not clear this gate. If you cannot separate the operations and cash flows, the analysis stops right there. Gate 2 asks whether the exit event is real. ASC 205-20 can apply when the component is sold, abandoned, exchanged, distributed to owners or classified as held for sale. The important word is real. A plan under discussion is not enough. A vague intention is not enough. Management saying, maybe we will exit this unit someday is not enough. There must be a completed disposal or a proper held for sale classification. This gate protects financial statements from premature classification based on weak or uncertain plans. Gate 3 is where professional judgment enters the room. The exit must represent a strategic shift that has or will have a major effect on the entity's operations and financial results. There is no mechanical shortcut. A strategic shift may involve a major geography, a major line of business, a major equity method investment, or another major part of the entity. The word major is doing heavy lifting here. You must look at both qualitative and quantitative evidence. In simple terms, ask, does this exit change the business story in a meaningful way? There is one special acquisition case to remember. If a business or non-profit activity is acquired and at the acquisition date itself, it already meets held for sale criteria, then it is presented as discontinued operations from day one without applying the normal strategic shift analysis. Why? Because it was never intended to become part of the continuing business. But keep this exception narrow. It is not for a business that management later decides to sell. The held for sale condition must exist at the acquisition date itself. Before we move into examples, lock this decision tree. First ask, is it a component with separate operations and cash flows? If no, stop. Continuing operations. If yes, ask, has it been disposed of or classified as held for sale? If no, stop. Continuing operations. If yes, ask, is it a strategic shift with a major effect? If no, stop. Continuing operations. Only when the answer flows clearly through all gates do we reach discontinued operations. This is your mental checklist for every ASC 205-20 question. Now let us apply the checklist. Novatech sells its medical devices division. The division has its own management team, separate facilities, and distinct cash flows. It also represents around 40% of total revenues and is the company's entire healthcare sector presence. Gate 1 passes because it is a component. Gate 2 passes because the division was sold. Gate 3 passes because exiting a major line of business with such a significant revenue contribution changes the entity's operations and financial results. Conclusion: report it as discontinued operations. Now compare that with BrightDesk. It stops selling Task Mini, one small tool inside a larger productivity platform. The platform continues. The tool shared development resources, support teams, and infrastructure with other products. It contributed less than 3% of revenue and did not have separately tracked operations or cash flows. Gate 1 fails because it is not a clearly separable component. Once Gate 1 fails, we do not force the rest of the analysis. Even emotionally, management may feel they discontinued a product. But accounting asks a stricter question. Did they discontinue a qualifying component? Once something qualifies, presentation matters. On the balance sheet, assets and liabilities of the discontinued operation are shown separately. They are not netted into one convenient number. Assets get their own separate presentation and liabilities get their own separate presentation. Major classes may be shown on the face of the balance sheet or in the notes, depending on materiality and judgment. The key memory point is simple. Do not offset. Users need to see the asset side and the liability side clearly. On the income statement, discontinued operations are separated from continuing operations. Continuing operations appear first because they represent the ongoing business. Discontinued operations appear separately and include the operating results of the component, any gain or loss on disposal, and the related tax effect. Prior periods are also adjusted to conform so comparison remains meaningful. The discontinued section is reported net of applicable income taxes. This separation helps users ask a very practical question. What performance is expected to continue and what belongs to the exited part? Now let us handle the traps, because this is where exams and real-world reporting like to test attention. General corporate overhead that remains with the company should not automatically be pushed into discontinued operations. Interest on debt assumed by the buyer or debt that must be repaid because of the disposal is allocated to discontinued operations. Other interest may be allocated, but it is not always required. And if a later adjustment relates to the discontinued component, such as a contingency settlement, it stays in discontinued operations when recognized. Qualification is only half the game. Presentation discipline is the other half. Let us close with the memory card. Qualification has 3 gates: component, exit event, and strategic shift. Presentation has 3 anchors: separate continuing and discontinued results, separate assets and liabilities without offsetting, and net of tax reporting for discontinued results. If you remember one warning, remember this: a disposal is not automatically a discontinued operation. In the next class, we move to ASC 205-30, liquidation basis of accounting, where the story becomes even more serious. The business is no longer reporting as a normal going concern. If this class helped you, please like the video, share it with your colleagues and subscribe to Commerce Regiment. We will meet in the next class with liquidation basis.